Welcome to the Small Business Tax Savings Podcast, your weekly dose of accounting and tax tips specific to small business owners. You will be on your way to growing your business and paying the least amount in taxes as legally possible. Here's your host, Mike Jezoshek, CPA.
Hello and welcome. Today's topic is how is my entity taxed? Now, the entity that you use for your business plays an important role in many different areas of your business, taxes being one of them. And there seems to be a lot of confusion among business owners related to how their entity is taxed. And so what we're going to do today is clear the air here and get down to the details of what you need to know about how your entity is taxed. So to get started, let's just talk about what business entity types are there. Now, an entity is generally something that you set up at the state level. And before we get into how your entity is taxed, we want to talk about the various entity types that we see most small business owners fall into. And there's three main ones that there is. There is no entity, which is also kind of known as a sole proprietorship. There's a limited liability company, an LLC, or a C corporation. Now, you'll notice you don't see S corporation in that list, and that's because an S corporation is not an actual entity at the state level. Rather, an S corporation is a tax election. A tax election that can be made with either an LLC or a corporation. So you can have an LLC taxed as an S corporation or a corporation taxed as an S corporation. Your entity type would remain the same at the state level. You're simply electing for your entity to be taxed as an S corporation. Now, we did an entire series on S corporations, and so if you want to learn more about those, you can go to taxsavingspodcast.com/S Corp, and we have a whole series of podcast episodes and blog posts and everything else all about S corporations. But again, when we talk about what business entity types are there, we see most business owners fall into these three. And specifically kind of the first two, but no entity, which would be a sole proprietorship, just someone just opening up a business with no physical entity at the state level, a limited liability company, an LLC, or a C corporation. And then an S corporation is just a tax election of one of those. Now, the next thing that we want to discuss is this idea of a pass-through entity. So what is a pass-through entity? Most small businesses do not pay federal income taxes at the corporate level. Instead, the profits from their business flow through or pass through to the owners of the company where it is then taxed. So examples of pass-through businesses include a sole proprietor, LLC, an S corporation. Really, a C corporation would be the only entity that is not considered a pass-through. In a C corporation, the company pays taxes on the profit of the business at the corporate level. So let's go through a basic concept. If you have a pass-through entity, you have income and expenses related to the business that are reported on a business tax return. That could be a Schedule C, that could be a 1065, that can be an 1120S. Then the profit from those businesses are then reported to you on your personal return, where you as the owner pay taxes on it individually. So that's the concept of a pass-through entity. You report business income and expenses on a business tax return, no taxes is paid at the corporate level, and then they pass through to you where you pay taxes on that profit of that business individually. So then the question comes up is, where do you report your business activity and how is your business income eventually taxed? And so as we've kind of been talking about so far, is that if you have a pass-through entity, you will pay taxes personally on the profit of your business. If you actively participate in that business, it will be considered earned income, and that's going to be subject to ordinary income tax rates. And some businesses may also be subject to self-employment taxes. And we did a full blog post and podcast episode on how earned income is taxed. So check that out in the show notes where we have an article and a blog post called Earned Income, How is My Income Taxed? If you kind of want to learn a little bit more about what earned income is taxed and what level that is. But where do you report your business activity will really depend on your entity type. So let's look at a sole proprietorship, which is no entity, or a single member LLC. So sole proprietorship or single member LLC where no S Corp election is elected. You would file your business information, your income and expenses, on a Schedule C on your personal tax return. And with that, with a sole proprietorship or a single member LLC where there's no S Corp election, you're going to pay both ordinary income taxes and self-employment taxes on the business profit, and you're going to pay that on your personal tax return. Now let's look at a partnership or a multi-member LLC, again, assuming that there's no S Corp election. And with all these examples that we're going through, we're assuming that the owners of these entities are you as an individual. So with a partnership or multi-member LLC with no S Corp election, you're going to file your business information, your revenue, income, and expenses on a Form 1065. Each partner in that entity is then going to receive a K-1. And that K-1 is going to report their share of activity, and they're going to use that K-1 to report it on their personal tax return. Each active individual partner will pay both ordinary income taxes and self-employment taxes on their share of business profit, and they're going to pay that on their personal tax return. Now let's look at an S corporation. With an S corporation, again, you can be an LLC, taxed as an S corporation, or a corporation taxed as an S corporation. But if you elected S corp status for your entity, you're going to file your business information, your income and expenses on Form 1120S. Same with a partnership. With an S corporation, each owner is going to receive a K-1 with their share of activity. And that K-1 is going to be used to report that activity on their personal tax return. And then each active individual owner will pay ordinary income taxes on their share of profit from the business, and they're going to pay that on their personal tax return. Let's finalize this with a C corporation, which is not a pass-through entity. With a C corporation, you're going to file your business information, your income and expenses on Form 1120. The corporation will then pay federal corporate taxes on the income of the business at the corporate level. So again, a C corporation with no S Corp election is not a pass-through entity. The corporation pays the taxes. If you have a sole proprietorship or single member LLC with no S Corp election, a partnership or a multi-member LLC, you're going to be filing those and you're going to pay ordinary income taxes and self-employment taxes on that income. If you have an S corporation, you're going to pay ordinary income taxes on that income. With a sole proprietorship, single member LLC, partnership, multi-member LLC, or an S corporation, all of these are flow-through entities. So you're eventually going to pay taxes on the profit of these businesses on your personal tax return. So let's go through an example because I think that this will help flush out this idea. Let's go to an example of how business income is taxed. And this is especially important as we prepare for year end. And that's why I want to dig deeper on this by giving you an example because I think it's going to help paint a much more clear picture. All the time we hear from business owners that had a profitable business but wanted to keep money in the business to help it grow. So instead of taking it out, they kept money inside the business. However, when it comes to tax time, they got hit with a tax bill. And the complaint is always, I haven't taken any money out. How could I owe taxes? Or I only took a little bit of money out. How come I'm paying taxes on all of this income? And as we discussed above, we know that with a pass-through entity, you are taxed on the profit of the business, regardless of how much money you leave in or take out of the business. And this is an important concept to understand. So let's use some numbers for a pass-through business to help make this clear. Let's say you have business revenue of $150,000 and business expenses of $50,000. And then you take owner draws or distributions of $65,000. So using this example, the profit of the business is going to be $100,000. We take your business revenue of $150,000 minus your business expenses of $50,000. Therefore, the business profit would be $100,000. And because that's the business profit, the owner, it's going to pass through to them and they're going to pay taxes on that $100,000, that business profit personally. So they're going to pay taxes on $100,000, the profit of the business. Now you'll notice in the example, the owner only took out $65,000 from the business. But because the total profit of the pass-through entity was $100,000, they still would pay taxes on the full $100,000. So this is an important concept to think about. Now, let's assume that in year 2, there was no income or expenses, but the owner took a draw for the remaining $35,000 from that first year. In that year, there would be no profit because there's no income or expenses in year 2. So the owner would not pay any taxes, even though they received the $35,000. And that's because they technically paid the taxes on that in the prior year when they showed the profit for that business. Now, of course, this is a very simplified example, but I hope that helps make sense or helps clear the water a little bit about how pass-through taxes work. So some key takeaways of how your business entity is taxed. The first one is an S corporation is not a physical entity type, but rather a tax election at the federal level. You need to have either an LLC or a corporation that then elects S Corp status. And when you elect S Corp status, you still remain an LLC, you still remain that corporation. That entity structure at the state level remains the same. Now, most businesses do not pay federal income taxes on the corporate level. Instead, the profit from their business flows through or passes through to the owners of the company, and that is where it's taxed. Pass-through businesses include sole proprietorships, LLCs, and S corporations. A C corporation is not a pass-through entity, and instead a C corporation would pay taxes at the corporate level. If you are active in a pass-through business, you're going to pay ordinary income taxes and possibly self-employment taxes on the profit of the business. And with a pass-through entity, you are taxed on the profit of the business regardless of how much money you leave in or take out of the business. And so that's an important concept to think about, especially as we're coming up on year end. Now, that doesn't mean that leaving money in the business is a bad thing, because remember, if you have profit and you leave money in the business, you're going to pay taxes on it this year. But if you then take that money out in future years from the profit, you're not going to pay taxes on that. So just keep that in mind as we're closing out the year, because once the calendar rolls over to the new year, the majority of tax planning opportunities get tossed out the window. So you have time now. Take some hours, take some time, listen to our podcasts, especially the ones that we have coming up, and implement the tax strategies that we're talking about so that you can ensure when you file your tax return, you're paying the least amount in taxes as legally possible. So this is just a concept that I wanted to get across as we're leading up to year end, because I think it's so important to understand how your business entity is structured and how your business entity is taxed, because it means so much when it comes to tax time. Now, if you want to learn more about this or kind of dig deeper or prefer to read this type of text, you can join or go to our website, taxsavingspodcast.com, and go to our learning center where there's going to be a blog specifically on this topic. As we close out the year, we're going to continue to talk about tax saving strategies and talk about things that we can do to lower that profit of your business, things that we can do to maximize your deductions and make sure that you're taking advantage of every possible tax deduction legally possible to you in your business. This is an important time of the year because, again, once 12/31 rolls over, tax saving strategies get thrown out the door for the most part, and we're on to a new year. So I hope that this was helpful. Thank you for listening to another episode, and I will see you next week when we continue this discussion of year-end tax planning. Have a great week, everyone.
This has been another episode of the Small Business Tax Savings Podcast. If you enjoy our weekly episodes, please leave a review and share with other business owners. You can find previous episodes and more information at www.taxsavingspodcast.com. Thanks for listening and have a great day.